A deep dive into the acclaimed investment classic Active Portfolio Management to End edition, a must-read for professional investors. Why has this book, with global sales exceeding 1 million, become a cornerstone for investors? How does it guide everyday people to navigate the market's complexities and achieve success? Let's explore the quantitative world of Richard Grinold and Ronald Kahn to unlock the secrets of active investing. The origins and evolution of active investing. Portfolio management didn't emerge overnight, it's the culmination of a century of financial theory. In the early 20th century, investing was a chaotic gamble driven by intuition and luck. In 1952, Harry Markowitz introduced the mean-variance model, advocating diversification to balance risk and return, transforming investing into a science. Grinold and Kahn build on this legacy in active portfolio management, blending behavioral finance and quantitative analysis. Their goal: to solve the core challenge of achieving consistent excess returns in competitive markets. Markowitz's theory laid the foundation for modern portfolio management, emphasizing risk minimization through optimized asset allocation. In the 1960s, Eugene Fama's efficient market hypothesis challenged active investors, suggesting prices reflect all information, making outperformance nearly impossible. Grinold and Kahn disagree, arguing that market inefficiencies like information asymmetry, behavioral biases, and liquidity frictions create opportunities for active management. The book traces the evolution from Markowitz to Fama while introducing tools like the information ratio and fundamental law to provide a systematic framework. Take Warren Buffett's 1,980 seconds investment in Coca-Cola as an example. He seized on the stock's undervaluation tied to its brand strength. His success wasn't luck, but rooted in deep fundamental analysis, aligning with the book's core idea. Active investing thrives on spotting market mispricings and building optimized portfolios. Buffett analyzed Coca-Cola's global market share and long-term profitability, concluding it was undervalued, leading to a $1 billion investment in 1988 that yielded massive returns. This case vividly illustrates active investing's power, combining scientific analysis with insightful judgment. Grinold and Kahn bridge theory and practice, using mathematical models and case studies to show how to seize market opportunities. This progression from theory to application provides a robust foundation for active investing. Beyond Markowitz and Fama, the book incorporates broader academic contributions. In the 1970s, Robert Merton's option pricing model offered new perspectives on risk management, emphasizing dynamic portfolio adjustments to market shifts. Grinold and Kahn adopt this idea, suggesting active investors use quantitative tools to capture nonlinear price changes. For instance, Merton's model inspired the use of option strategies, like buying put options to hedge downside risk. During the 1997 Asian financial crisis, Hong Kong fund manager Ji Hao Liang used regional economic data and options hedging to avoid currency devaluation losses, achieving a 5% positive return. The rise of behavioral finance adds further depth to active investing. Grinold and Kahn cite Richard Thaler's work, noting how the endowment effect causes investors to overvalue held assets, missing optimal sell opportunities. In the early 2000s tech bubble, many clung to dot-com stocks, ignoring crash signals, and suffered heavy losses. The book quantifies these biases through models, advocating systematic frameworks to overcome psychological barriers. This integration of psychology, economics, and statistics transforms active investing into a multidisciplinary system, supporting advanced quantitative strategies, the truth and flaws of market efficiency. Active investing hinges on challenging market efficiency. The efficient market hypothesis claims asset prices reflect all available information, with random fluctuations making consistent outperformance unlikely. Grinold and Kahn argue that market efficiency isn't absolute. Delays in information dissemination, irrational behavior, and structural frictions create opportunities for excess returns. The book centers on the information ratio, defined as excess return divided by tracking error, measuring a manager's stock-picking skill and risk control. Through mathematical proofs, the authors show that high information ratios stem from accurate forecasting and diversified investments. For example, Bridgewater's Ray Dalio in the 1990s predicted bond market shifts using macroeconomic data and market sentiment, achieving significant excess returns. His strategy exploited delayed market reactions to macro information, validating the book's view on market flaws. Behavioral biases further expose market inefficiencies. Daniel Kahneman's loss aversion theory shows investors fear losses more than they value gains, leading to irrational decisions. Before the 2008 financial crisis, many fund managers chased subprime mortgage bonds, ignoring risks, and faced massive losses. The book cites Kahneman, noting how overconfidence and herd behavior create buying opportunities for disciplined, active investors. In the 90s market low, fund manager Bruce Berkowitz bought undervalued bank stocks based on fundamental analysis, doubling returns in 3 years. Liquidity differences also create market gaps. The book highlights that small-cap stocks or emerging market assets, with lower liquidity, reflect information more slowly, offering opportunities. In the 1990s, emerging markets growth drew active funds that profited by analyzing local firms' financials and industry prospects. Grinold and Kahn stress that understanding market efficiencies limits is the first step in active investing. Investors must use quantitative analysis and behavioral insights to uncover overlooked opportunities. Exploiting market flaws requires systematic methods like analyzing order flow to capture short-term price discrepancies. Renaissance Technologies Medallion Fund, for instance, uses order flow data to exploit millisecond-level price anomalies, earning millions daily. The book also discusses event-driven strategies, leveraging short-term fluctuations from corporate announcements or policy changes. In 2018, after U.S. tax cuts, savvy investors analyzed benefited industries' financials, boosting retail and manufacturing stocks for strong returns. The overreaction hypothesis, cited from DeBont and Thaler, notes markets overreact to news, causing prices to deviate from fundamentals. In 2020, Tesla's stock soared on electric vehicle hype, but active investors, analyzing production and cash flow, deemed it overvalued, avoiding losses by shorting or steering clear. These strategies combine behavioral insights with data analysis to exploit market inefficiencies, the scientific core of the fundamental law. The essence of active investing lies in the fundamental law. Excess returns come from accurate predictions of asset performance. Grinold and Kahn define the information ratio as the information coefficient forecasting skill times the square root of breadth number of opportunities. This formula is both a theoretical cornerstone and a practical guide. George Soros, 1992, bet against the British pound, predicting the UK's inability to sustain high exchange rates, earned billions through fundamental analysis and leverage trades. The book stresses combining fundamental analysis with quantitative models to assess undervaluation. In 2012, Apple's stock dipped due to pessimism about smartphone growth, but active investors, analyzing its innovation and supply chain, bought in, reaping multifold returns. The fundamental law also emphasizes diversification to reduce the impact of single forecast errors. Renaissance Technologies Medallion Fund, through high-frequency trading and diversified bets, achieved annualized excess returns above 30% by analyzing thousands of assets' micropatterns. Grinold and Kahn note that the fundamental law is dynamic, requiring constant updates to models and information. During the 2020 COVID-19 crisis, market pessimism tanked aviation and tourism stocks, but investors analyzing cash reserves and recovery potential found undervalued gems. This dynamism keeps active investing vibrant and ties into risk management discussions. Practicing the fundamental law requires mastering data collection and analysis. The book suggests building proprietary databases integrating financial statements, industry reports, and macro data to boost forecast accuracy. New York fund manager Sarah Winston predicted a chip shortage by analyzing semiconductor supply demand, achieving 20% annualized returns over 3 years. The book introduces expected return decomposition, breaking returns into earnings growth, valuation changes, and dividends to pinpoint excess return sources. In 2015, Amazon's AWS profitability was underappreciated, but active investors analyzing its revenue structure bought in, earning substantial gains. Grinold and Kahn stress aligning fundamental analysis with industry cycles. In 2021, the energy sector entered an upcycle due to global recovery, and investors analyzing supply demand and geopolitics seized opportunities in oil and gas firms. The book advises regularly updating industry models and adjusting forecast weights to adapt to market shifts. This practical approach brings the fundamental law to life, the science and art of risk management. Active investing isn't a high-return gamble. Risk management is its backbone. The book categorizes risk into systematic market-wide and idiosyncratic stock-specific, advocating diversification and hedging to reduce volatility. Grinold and Kahn introduced tracking error to measure a portfolio's deviation from its benchmark, stressing controlled volatility in pursuit of excess returns. Norway's sovereign wealth fund, for example, diversifies globally across stocks, bonds, and real estate, achieving stable long-term returns. The book recommends multifactor models to analyze risk sources like industry, style, and macroeconomic factors. Citing the Fama French three-factor model, notes market, size, and value factors explain most portfolio volatility. In the late 1990s tech boom, tech-heavy funds suffered due to concentrated industry risk, while balanced portfolios performed steadily. Risk management balances returns and volatility. During the 2000 tech bubble burst, overexposed fund managers faced heavy losses, but hedge fund manager John Paulson, analyzing housing market bubbles, shorted subprime bonds in 2007, earning massive returns. The book details hedging tools like options and futures to reduce volatility while preserving upside potential. Dynamic risk management is another focus, suggesting adjustments to positions and hedges based on market conditions. In early 2020, fund manager Cathie Wood adjusted ARK Funds holdings, reducing high-risk tech exposure and increasing innovative firms, dodging market turbulence. This blend of science and art makes risk management a cornerstone of active investing. The risk management toolbox extends beyond diversification and hedging to include scenario analysis and stress testing. Scenario analysis simulates extreme market conditions to assess potential losses. In 2020, Bridgewater used scenario analysis to predict supply chain disruptions, adjusting its portfolio to favor healthcare and tech, avoiding downturns. Stress testing evaluates portfolio performance under extreme volatility, with Monte Carlo simulations generating thousands of scenarios to assess risk exposure. Swedish investor Hanna Lindström, managing a global equity fund in 2019, used stress tests to identify high sensitivity to rising interest rates, adding fixed income assets and interest rate swaps to stabilize her portfolio in 202 rate hikes. The book also emphasizes tail risk, low probability, high impact events. In 2020, when oil prices briefly turned negative, unprepared funds suffered, but those using futures hedges emerged unscathed. These tools underscore risk management's critical role in active investing. Building an optimized portfolio. Portfolio construction is the heart of active management, balancing returns, risk, and costs. Grinold and Kahn outline mean-variance optimization, maximizing the Sharpe ratio return divided by volatility while accounting for transaction costs and taxes. Vanguard's John Bogle, known for passive investing, inspired active managers with his low-cost approach, boosting net returns by minimizing fees and trading frequency. The book advises using quantitative models to select high expected return assets while controlling costs. The Black-Litterman model, for instance, blends market equilibrium with subjective forecasts for optimal allocation. British fund manager Aaron Cartwright, managing a small-cap fund in 2015, used fundamental research and options hedging to achieve 15% annualized excess returns over 3 years. Portfolio construction must consider constraints like liquidity needs and regulations. The book suggests periodic rebalancing to maintain target risk levels. In 2021's supply chain crisis, active investors analyzing energy dynamics overweighted renewable energy stocks, capturing excess returns. The book also discusses multi-asset strategies, using bonds and commodities to reduce overall volatility. Factor investing is another key, with the book analyzing value, growth, and momentum factors to enhance returns. Morgan Stanley's team in the 2010s combined value and momentum factors, capturing growth in tech and consumer sectors. This systematic approach shifts active investing from intuition to science. Factor investing enhances portfolios through multi-factor models combining value, momentum, quality, and low volatility factors. Singapore fund manager Hui Ling Chen in 2020 used quality factors to select financially robust consumer firms and momentum factors to ride e-commerce trends, achieving 18% annualized returns. The book advocates factor rotation, adjusting weights based on economic cycles, growth factors and recoveries, low volatility and downturns. In 2022's high inflation environment, investors overweighted low volatility utility stocks to reduce portfolio swings. These strategies leverage factor analysis to boost excess returns, behavioral finance, and investment discipline. Active investing demands not just skill, but psychological discipline. The book cites behavioral finance, noting emotions as the enemy of success. Grinold and Kahn highlight how overconfidence, anchoring, and herd behavior lead to poor decisions. During the 2008 crisis, panic-driven sales of quality assets caused investors to miss the rebound. Citing Kahneman's anchoring effect, the book notes how initial information biases decisions, ignoring new data. Peter Lynch, managing Fidelity's Magellan Fund, reviewed decisions weekly to ensure rationality, achieving 29% annualized returns over 13 years. The book stresses discipline as a core competency, advocating rule-based processes to counter emotional biases. Setting clear buy-sell criteria prevents strategy shifts due to market swings. Behavioral finance shows markets overreact to negative news, creating undervaluation opportunities. Post-2016 Brexit, panic drove down UK assets, but investors like David Tepper bought undervalued bank stocks, reaping strong returns. The book discusses mental accounting, where investors irrationally allocate funds, missing better opportunities. To build discipline, suggests keeping an investment diary to log decision logic and outcomes. Canadian investor James Holt in 2018 found frequent trading in volatile markets raise costs, so he extended holding periods, boosting returns. This self-reflection is key to active investing success, the future and insights of active investing. Active investing faces both opportunities and challenges ahead. The rise of big data, AI, and machine learning is ushering in a new era of quantitative investing. The book predicts data-driven decisions will dominate future active management. Renaissance Technologies uses machine learning to analyze vast market data, boosting forecast accuracy by detecting patterns human investors miss. Yet, technological advances bring challenges. Faster information flow and fiercer competition may shrink excess return opportunities. Grinold and Kahn urge investors to adopt new tools and maintain sharp market insights. Bridgewater's AI system analyzes global economic data in real time, sustaining its edge. AI opens new frontiers, with machine learning analyzing unstructured data like social media sentiment and supply chains to improve stock picks. In London fund manager Thomas Evans used natural language processing to analyze corporate earnings call tones, predicting performance and capturing 12% excess returns from undervalued retail stocks. AI also optimizes trade execution, reducing market impact costs via reinforcement learning for optimal trade timing. The book notes AI's role in analyzing earnings reports and news sentiment to enhance forecast accuracy. Sustainable investing is another rising trend, with ESG environmental, social, governance factors becoming a focal point. In the 2020s, investors screened firms for carbon emissions and social responsibility, balancing ethics and profits. Norway's sovereign wealth fund integrated ESG criteria, achieving both social impact and stable returns. The core lesson of active investing: success stems from scientific methods, disciplined execution, and continuous learning. No matter the market, understanding fundamentals, managing risk, and resisting emotional biases remain key to winning. The book quotes, "Investing is a marathon, not a sprint. Active investors must take a long-term view and relentlessly pursue excellence." Erin Cartwright's story illustrates this. During 2020's COVID turmoil, she stuck to fundamental-based stock picks, using quantitative models and risk hedges to achieve 20% annualized returns by investing in vaccine-related biotech firms. Her journey shows active investing as a test of wisdom and resilience. Another case is Spanish fund manager Carlos Fernandez, who, during 2020's energy crisis, analyzed Europe's energy supply-demand imbalances, invested in undervalued renewable energy firms, and hedged geopolitical risks with options, earning 15% excess returns in a year. His success reflects adherence to fundamentals, precise risk management, and contrarian market insight. Active investing is challenging but full of potential. As Grinold and Kahn state, the essence of active management is combining science with insight to turn market uncertainty into opportunity. Whether novice or veteran, this book offers a clear roadmap to navigate the investment seas and ride the waves to success.